Yeah, so firstly, thank you everyone on the phone. Like I mentioned earlier, we will be recording this and distribute it afterwards. What we like to do every year is we kind of go through open enrollment and kind of the next year's planning. We like to bring our financial advisors and, just make sure you know who they are. They are available to you and, only here to help, and they're completely free of charge. Today we'll hit on some just general information, endorsing enrollment and letting you know some of the services they have available. It's Alpha Capital. They're here out of Lakewood, Colorado. So with that, I'll turn it over to you, Ian Mark.
All right, great, and thanks for the intro, Travis. Again, this is Mark L. and Ian Campbell with Alpha Capital. Our goal as acting financial advisors over your 401k plan benefit is to strictly support you in your retirement savings and your retirement journey. What's real most common is employees such as anyone that's on the call or anyone within the company can call us. We've got our cell phones, our emails, our desk lines. You can call us at any time. We can pull up your account. Your 401k plan benefit is hosted at Paychex. So just to differentiate, Paychex is where you log in to see your account balances and to manage your investments. We have view access to your account, so we can help you one-on-one if you want us to call and give us a quick piece of advice where we can tell you if you're invested properly, if you're taking the appropriate risks, or if there's some modifications or adjustments. Our goal for today is to walk you through some of your 401k plan highlights. We're going to talk about some investments. We're going to talk a little bit about the markets and the importance of compounding, a little bit of investment 101. So with that being said, both Ian and I will present. We're going to deliver this PowerPoint through GoToMeeting. Again, it's recorded. That way you'll be able to have access to it later on as well.
Thanks, Mark. A couple housekeeping items. We wanted to make sure everybody was aware of the 401k overview and some of the plan design basics. Eligibility is set at 18 years old and 1 month of service. The company match did get increased from about a year ago, so I want to make sure that you are aware of that as well. It is 38% on the first 6% that you put in, and then for a total of 2.28%. The schedule below where it's employee and company match, you'll see if you put in 1, you'll get 0.38 and so on. Employees would have to put in at least 6% or more to get the full 2.28 company match. As a reminder, everyone, just make sure you know what you're contributing. So verify that either in the Paychex website system, either on the retirement services, or verify on your payroll side of things too of what your contribution rate is. Use this as a reminder. If you're contributing less than 6 and you're leaving money on the table, we'd highly educate folks saving more than 6, and we'll talk about that here on upcoming slides. Everybody in the company is actually doing a very, very good job of saving above that 6%. So if you're one of those people, pat yourselves on the back. The national average is around 8%, and most of you are actually doing above that. So job well done. Keep up the good work. A couple changes that have been implemented going forward as of 1/1 is the vesting schedule. The vesting schedule did get updated and decreased from a longer period of time, I believe it was 4 or 5 years, down to 2 years. So the vesting schedule on those company match contributions is now on a 2-year vesting schedule based off of your hire date. So your hire date, if you've been here for 2 years and you left tomorrow, then you would get that full company match that you received previously. Now, if you had only worked at the company for, say, 1.5 years, you would only have received half of the company contributions that you had been given up to that point. So somewhat of a good way to explain it would be kind of the golden handcuffs type thing, but it is a vesting schedule, and the vesting schedule is only on your contributions, or sorry, the company contributions. It's not on your contributions. So the vesting schedule, again, to repeat that, is on the company contributions or the company match, not your contributions. There are two different types of contributions that are available to you. You have the traditional or pre-tax contribution or the Roth after-tax contribution. The difference between the two is when you're taxed. You can either be taxed in today, before you put the money in, or you can be taxed on the outbound when you pull it out in retirement. The difference between the two is what your effective tax rates are going to be now versus what they would be in the future is what you would hedge. Because we do not know what tax rates are going to be in 10, 20, 30 years from now, you could argue that it's somewhat of a best guess case scenario. We do see younger people or individuals that are in a lower tax bracket will often do the Roth contributions. Folks that are in a higher tax bracket or looking to reduce their taxable income will do the traditional 401k or pre-tax contribution. You can change it at any time from traditional versus Roth, and you can also change your contribution rate at any time as well by going into Paycheck's system and changing it in payroll. The 401k elective deferral limits did get increased for 2020. They got bumped up $500 in the regular contribution limits, and also the catch-up contribution limit did get bumped up by $500. You can see those as referenced below. For 2019, they are $19,000. If you're over age 50, you can put in an additional $6,000 in the form of a catch-up contribution for a total of $25,000. I'm going to turn it back over to Mark to see if he has any other comments on this slide.
No, it's just it's important to know what you're contributing now. That's one thing that tends to slide. We typically like to advise that whatever current contribution rate you are right now, since we have a brand new year, 2020 coming up, a lot of people will bump it up by 1% or 2% and just keep that path moving forward. As Ian mentioned, 8% is our national average. We as advisors actually recommend that you get to 10% or more at some point in time. And the way people do that, we advise people to, is just bump it up by 1% or 2% each year until you reach that goal.
So hopping over to just some fundamentals, there are a handful of folks that are not enrolled in the 401k plan, and this may be the first time that you've heard from us or heard of us. And we wanted to help provide some details around getting into the system and enrolling in the 401k. Paychex has a 1-800 line that can help you with that retirement services enrollment. That number is referenced there. This presentation will also be available in a PDF form for those who need it as well. Paychex Online does have their Flex login, and the retirement services section is where you would find those enrollment steps.
Okay, so what you're seeing on screen right now is our best help to you. So please understand, as financial advisors, we have no self-interest in dealing information to ourselves that's going to benefit ourselves. We are truly acting in your best interest. So what you're seeing on screen right now is our investment allocation guide. All of these investment choices that are in your 401k plan are available to you. Ian and I like to think of this reference guide, this investment guide, as if we were working at Lynker today and we were, say, a moderate risk tolerance investor. This is how we would deploy and use the investments in your 401k. And the reason why we like to do this is because we know that with research that our crystal ball allows us to give a best guess as to what we would do to put you in front of the best performers given the current market conditions. So again, it is an allocation, it is a guide, it is our best guess to help you out. We understand and know that many people, when you look at these mutual fund choices, that it's not something that people go and do a lot of research with. And so we want to provide some help as to what we would do if we were you, and provide these allocation models. Notice they are profiled in risk from conservative to aggressive. You'll notice right above, say, example, the moderate column, there's a 50-50. What that really is indicating is it's a 50% stock, 50% bond weighting. And we like to have a mixture of stocks and bonds. Notice in the aggressive column, right above there is an 80-20. We know that stocks provide the risk in your portfolio. It provides the greatest potential for return, but it also, in times of bad markets, stocks provide the greatest increase for losses as well. So the 80-20 aggressive model means you just have more stock holdings as a percentage of bonds at the rate of 80-20. So that all being said, the top half of this box, the larger box, is a hands-on approach. We are going to produce this allocation guide once a quarter. This one's dated October 2019. It's our most recent allocation guide. The next one will be in January, and then April and July of next spring and next summer. So every quarter you're going to have this allocation guide. The call to action on your part, if you want to utilize our investment advice, is that you actually have to log into your Paychex account. It's going to take you 5 to 7 minutes to click the tab to say, I want to change my investments. And then you simply have to rekey in the percentages. And notice they all add up to be 100%. You simply key in the percentages and follow it. Some people go line item straight up. Some people modify it a little bit. It's completely your choice, but it is our guide to you. Notice the bottom smaller box has the target date fund. This is also a great option. In fact, about 7 out of every $10 going into 401k plans are going into these target date funds. And it's meant to be a hands-off approach. So inversely, if you don't want these quarterly updates and to follow the investment advice on the top half, you can simply choose a target date fund and be indicative of the year of which you would reach age 65. They're banded in 5-year increments. You would choose that vintage year of which you would reach age 65, and then simply choose as your sole separate investment choice at 100%. So that's a very viable option, and we want to bring light to that. Now, target date funds, as a do-it-for-me approach on autopilot, if you will, is designed to be very aggressive when you're younger, and again, mostly stocks, holdings, and very few bonds, and then it de-risks as you get older. So the 2020 fund sees you as an individual that's going to retire next year, or say within a few months, maybe potentially a 65-year-old individual. That is going to be about a 50-50 moderate blend. Inversely, if you're a 20-year-old individual and you're going to retire in the year 2060, that would be about a 85-90% stock to 15-10% bond. So very, very aggressive. So that glide path is automatic for you, and that's why they're so popular.
And just to add to that, you can change your investments at any time. Whatever you decide today, tomorrow, a year from now, you can always adjust it at any time. Now, if you do make changes after the markets close, it would happen, or those changes would go into effect either the following day or the next business day when those markets are open. There's no cost of going in and out of any mutual fund or any allocation column at all. Any percentages, you're free to change them. There's no trading costs. There's no loads on the front end. All of these funds are all institutional or the lowest share cost available, indicated by like R6 and so on. So they're all very low cost, or the lowest cost available from a mutual fund expense ratio. Just a quick mention in regards to rolling over or rolling out of funds. If you're no longer employed by Lynker in the future, you can reach out to Paychex Retirement Services team, and they can help with a distribution. But also the opposite works. If you've got an old 401k plan, old IRA out there at a former job that you'd like to consolidate into the plan, you can also reach out to them for assistance and help. It is normally a two-prong approach. There's a form that Paychex will have you fill out. It's a screenshot here that, as you just see, there's a couple details on the next page as well. And they will want you to reach out to your old provider, get your old provider to literally mail you a check that has the details. It's kind of faint to see here, but kind of in the middle it says Paychex for the benefit of your name and your social security number is what they will want the prior provider to put on that check or make payable to. So there is instructions on these forms. If you have any questions around rolling over or leaving or taking distributions, feel free to reach out to Mark or I, or even calling Paychex directly. We'd be glad to help provide some due diligence and information around that process.
All right, so this particular slide is super, super important. And we all know and understand that investment started at an early age is going to have your best benefit. So when we tend to meet with individuals, we see a lot of anxiety. We see a lot of people potentially in their 40s and 50s that are just starting their savings journey because they've had a lot of expenses early in life. But we also hear younger people that are unable to save as much as they'd like to. Maybe their student loans, brand new mortgage payments, raising kids and things of that nature. So there is a lot of pressure on your wallet either way. And so what this slide is intended to do is give you some examples of the power and time of compounding of money. So investor A at age 23 invested $5,500 per year for 9 years until age 32, and then for whatever reason in this scenario just stopped saving. They couldn't afford to save anymore. And over the course of time to age 65, just with time value of money, standard rates of return of around 7-8% in the market, ended up with just short of $1 million. So not bad for only saving for 9 years. Now inversely with investor B, which is in the middle in that teal color, almost the opposite. Investor B started at age 32 and invested the same amount, $5,500 per year, obviously for 34 years had to cough up $187,000 total of investment dollars put in. But at age 65, even with 34 years invested and only compared to 9, investor A actually had less money because of the value of time over the first 9 years and not having that time. The best case scenario is the very bottom investor, investor C. This person was able to save throughout the course of their working career from age 23 all the way to age 65. That's our best case scenario, where you end up with just short of a couple $1 million in that investment journey. So for those of you that are on this call that are younger, if we could, come through the phone and shake a shoulder or create a call to action, this would be it. And I know it's hard, but it all starts with budgeting and making sure that you're spending wisely and putting some money into your 401k, your savings and all that, just paying attention to that. And, spending some time looking at where you can save is ideal for an action point.
So a question came up on the chat. Does it cost anything to carry over or roll over your previous employer's 401k into the Lynker plan? The best answer would be no, it does not, from a taxing standpoint or distribution or early withdrawal standpoint. If you are taking it in the form of cash, then you may potentially have to take an early withdrawal penalty or pay your taxes if you haven't paid taxes on it. But to process that from an old provider over to the new provider, the old provider may have a fee of around $25 to $50 for them to talk to you on the phone and cut you and mail you the check. It's very common and customary to see that small fee for them to process that distribution for you. But that would be the only fees that you would be subject to if you were going from a qualified account to a other qualified account. Going to the next piece would be a retirement savings checkpoint. This is not intended to scare you or bring fear to you. This is just a barometer to see where you are at on the pace of savings, to see competitively where you would rank in relative to your peer group that would have similar incomes or household incomes. So the thought process here is to find your income and to line that up with your current age. If your household income is greater than that, maybe just use yours or your spouse's and then combine the total there. You would line it up with the current age and then find the multiple. You would times that multiple by your actual household income. For example, the 40-year-old, that point at $50,000 would be 1.7. 1.7 times 50 grand would be $85,000. So to reiterate that, a 40-year-old that makes $50,000 should have had or has saved up roughly $85,000 and continues to save roughly 5% each year to stay on track. Now, because those savings rates could be higher, this is as a recommended number, and everybody's scenario is unique. But using this as a barometer is a great tool. With that being said, we wanted to also mention just the annual savings needed if you're starting out today. Some of you are possibly behind the 8 ball a little bit or just getting going. We wanted to bring this up to help provide some context around, if you're saving 6% right now or saving 4% right now, to be aware that that may not get you to your goals and your replacement of income in retirement. Again, not intended to scare you. This is just math and showing these returns over time, basically calling it call to action that you need to make some adjustments if you are saving less than this. So again, you would line up your household income with your age. If you don't have anything saved up right now, this would get you back on track into retirement. So as an example, 40-year-old individual, $50,000 of household income or salary, you save 0 today, you may need to save roughly 16% every year until retirement. There's a lot of retirement calculators that are available online, also in the Paychex website. Use that, utilize some of those tools and resources to figure out where you're at, and we'd love to help advise you around that if you have any personal questions around those topics as well.
All right.
Guys,
so
I
one of the common
I think you had another question in the chat.
Go ahead. Yep.
I was just going to say, I think you have another question in the chat from a couple minutes ago.
So there was the PowerPoint available, but was there another question?
Yeah, they were asking about costs associated with changing asset allocations.
Yeah, so there's no cost of going in and out of any of the funds or changing allocations at all. You can change your investments every single day and not incur any cost with trading costs or changing your investment choices.
All right. So we only have a few minutes left. One of the common questions that we get is that the markets that we're in right now, all of you know, or at least should have at least an understanding that 2019 has been an exceptional year. What this chart is it is a kind of a 20-year outlook of what's happened in the S&P 500 index. And you know from investments that things go up and down. You can see from 1996 on the bottom left of this chart that we had a nice run up until the tech bubble, which was in the early 2000s. Markets dropped. We went into a brief recession. They climbed back up again until about 2007 when we went into the Great Recession, until about 2009. And then for the last 10 plus years, we've been on a pretty steady, what we call a bull run. And so the question is when is that going to end? And ultimately what we're seeing is that 2020 is lining itself up to be a positive year, no signs of recession, at least for now. Now the market news tends to focus on negativity, so you might hear some news. Obviously, we have an election coming up. We're talking about China trade, but all the business economic indicators are suggesting that for the next year or so, we may not see the returns that we saw this year in our portfolios, but more or less at average rates, at common rates of maybe somewhere between 4 and 8%. So growth, but at a much more subdued rate. So that hopefully answers that question. Of course, it is a crystal ball approach. I could be wrong, but that is our best guess on where the markets are headed for in the next 6 to 12 months.
So just before we hop over to the next slide, I wanted to kind of create a scenario here. This blue box that I highlighted on the screen is going to be the time period in which the data is going to be shown next. It does go up to the very bottom of that spike on the very top right corner of your page. So it goes up to basically the end of 2018. So I just wanted to be mindful of that. We have seen phenomenal performance from the end of 2018 all the way up to present day, in the high 20% numbers from a year-to-date return. So hopping over to the next slide, this is the impact of being out of the market and trying to time the market over a 20-year period of time from 1999 all the way to the end of 2018. The fully invested portfolio average return in that period of time was around 5.6%. In previous 20-year periods of time, the average would be closer to roughly around 7 to 8%. So I want to be mindful that 5 to 6% is not the norm. It's going to be more 7 to 8. If you miss 10 of the very best days in that 20-year period of time, just 10 of the best days, 5,000 plus trading days, you would have cut your return in half, greater than half. And then also, if you miss 20 of the very best days out of those 5,000, now you're in a negative return. And what I mean by that is trying to time the market. You're not often going to be able to pick the highs and the lows, but it's very, very difficult to do that. The box in the middle, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. And the best day in 2015 actually occurred 2 days after the worst day. I wanted to just be mindful, just the volatility showing here before we wrap this up. The very big spike that we saw in Q4 from September, which is up here in the top right corner, that went down to the end of December and then right back up in January. That was one of the biggest decreases we've seen in the market over its history, and then also one of the biggest increases as well. And hopping to the last piece is going to be the yield curve inversion of when are we going to see a pullback next. This slide, again, is not intended to provide any fear in your investing career, but just to provide some interest around when I would ideally see something else happening from a recession period of time. This yield curve inversion chart is a leading indicator of predicting recessions. It's one of the indicators, not the only one. So this chart represents the 10-year yield minus the 2-year yield and then plotted on a curve. The 0 percentile line will indicate when the yield curve was inverted, meaning that the 10-year yield was below the 2-year yield. Each dot plot has actually crossed 9 times over the last roughly 60 years, 7 of which led to a recession. The recessions are listed on that bottom right-hand chart, and then the time to the recession thereafter. So indicated would be the green dot was when it crossed the inverse line, and then the recession would be the gray bars that you see. The average period of time is 14 months. Again, that kind of coincides pretty darn closely to that election that we've got coming up as well, just by chance. Some of you may have seen the news, late summer, early fall. Back in August, I think it was end of August, the 27th, I believe, the yield curve actually did invert for a very, very short period of time. As you can see on this chart, the yield curve normally inverts for a much longer period of time. We are back up in the positive category. So a lot of economists will say that that didn't count, and I would also agree with them as well. So as this yield curve gets closer and closer to that inversion line, we do see the concerns of recession possibly coming up. So again, nothing to happen in the next 6 months to a year, but for those individuals that are very close to retirement, whether it's a couple years out, 5 years out, even 10 years out of retirement, be mindful of the risk that you're taking in your portfolio. Something that would be appropriate for somebody that's in those 60s and even late 50s would be much more in that moderate aggressive or moderate aggressive mention, or even the moderate column, so 50-50 or less on that risk tolerance, or picking a target date fund that would be appropriate. So we're coming up to that 30-minute mark. I wanted to toss it back to Mark, just final comments.
Yeah, so the real key takeaway is that investing is very, very emotional. It's according to that one slide that you saw, it's not trying to time the market, it's time in the market. So remember that when you hear news of a recession coming up, for those of you that are younger, you're not only going to live through one recession in your lifetime of a working career, you probably lived through 2 or 3 or maybe even 4 of them. Essentially, when the markets do retreat and correct, which they always do, you want to be steadfast in your payroll withholdings into your 401k plan, because you're essentially buying into these mutual funds and you're buying into your investments when they're at a reduced price, they're on sale. And so remember that. And it's a very important metric for success. You want to just have time in the market, be disciplined, keep putting into your accounts. The only people that we want to be mindful of are those that are getting close to retirement, to not having the years to recover from a recession, having to work longer. We want to be more mindful of the risks that you're taking on with those individuals. So you can always reach out to us for more individualized advice to fit your needs.
And just to be mindful of time, there's one quick question about doing some research on the mutual fund options and the holdings inside of those. Googling the ticker symbol is a great thing. I actually do that myself, which are the 4 letters of the ticker symbols, or 5 letters of the ticker symbols, I apologize. But you can also go on the Paychex website, and they'll have prospectuses available and also fact sheets available for each investment choice that'll have performance. I personally like to get real-time information that's up to that date, and the Paychex information would most likely be the end of the quarter, ending like September 30th would be the most recent information that they would have available too. So with that being said, any other questions that come up, feel free to email Mark or I, and we'll look forward to talking with each of you in the future if we have the choice to. Thank you, everybody.